Senior Executive Consultant with PSPRS. I work with Clark Partridge as well, and what we do is we help employers understand the actuarial valuations. What I'm hoping to do today is essentially present some key tables and key concepts from the actuarial valuations, as well as locating where you find the employer contribution rates for each tier, as Harold mentioned. And then I also hope to give you a good sense of how actuaries do their job and what feeds into these actuarial reports. For those of you who have read these reports before, some of this will just be a refresher. I hope you get a couple new concepts out of here that sit home with you. For those of you who have never looked at these before, I think this is a good foundation from which you can look at these reports in the future and then develop your own questions about what's going on. And as always, me and Clark, we're happy at a future date, if you do have any questions about your specific valuations, to answer those, set up time to discuss, and do any of that at your convenience. So with that, I'm going to go into the presentation. So what do the actuaries do for PSPRS? Really what they do is they're estimating the future cash flow associated with the benefits of every member and discounting that cash flow back to a present value. For those of you who are unfamiliar with discounting, it's essentially the process of finding what a future value is worth in today's dollars. So think of, inflation, right? We know that, say, tomorrow someone's going to pay me $107, or by tomorrow, I mean next year, $107, and there's going to be an inflation rate of 7%. Well, what would that present value of that $107 be today? And, approximately $100. So that's the, general concept. What they do is then determine the contributions needed to finance that future cash flow, assuming investment returns over time. So the money that employers and employees contribute to PSPRS, that of course gets invested, and that brings down what would otherwise need to be contributed to pay for those benefits in the future. And then the actuaries produce an actuarial valuation every year that aggregates this information as of June 30th each year and tells you the contributions that you need to budget for, what to incorporate into your financial statements for GASB reporting purposes, and how you can manage your pension liabilities. And it's important that I'll note that this is the valuations are done as of a point in time, as of June 30th of each year. That's important to know, because I know that there's a lot of fluctuation that can happen in a given year with any given employer. People can get hired, people can leave, but we're really looking at what the census data is for that point in the fiscal year each year, to give a complete picture of what's going on at that point in time. So with that, I'm going to start walking through some of these tables in the actuarial reports. The first one is the summary of report. It's the first table that appears in the reports, and it's exactly what it sounds like. It's a snapshot of the contribution rates, the funded status, and the change from the prior year. If you got a little bit of time and you just need a very quick look at, okay, what's going on from year to year, you can see the changes both in the contribution rate and the funded status on the pension and the health side. You can pull apart, okay, this is what's going on with the tier 1 and tier 2 rates and the tier 3 rates. I will say there's another table in the individual reports that's I think a little bit more helpful for getting the total picture of the employer contribution rates, and I'll show an example of that in a few slides. I say that because if there's an asterisk here on the tier 3 members where it says that it doesn't reflect it only reflects calculated rates and does not reflect legacy costs. The table I'm going to tell you reflects the legacy cost, which is the kind of the full rate that you'd need to contribute for that member. The summary doesn't show you the reasons for the change, and that's what this next section is. It's showing you the big picture categories that are impacting the contribution rates and the funded status in any given year. Most of these categories are going to be the same from year to year. There's some changes and fluctuations in what gets included. I'll highlight one of those categories because I'm going to walk through each one of these and just what they mean at a high level for the valuations. There's also, after this table, there's in every report, there's a little write-up on what they mean. So, if you ever forget or can't recall what exactly something means or how it's impacting it, you can always refer to those little write-ups that give just kind of a brief overview of what's going on. On the contribution rate side, I'm just going to walk through these categories. The first one is the asset experience. This is the investment returns and how it's impacting the contribution rate. It's relative to the assumed earnings rate, which is 7.2% for our tier 1 and tier groups and 7% for tier 3. And it's smoothed over a set of years. So what do I mean by smoothing? I mean that any gain or loss that the plan experiences in a given year, that gets smoothed over a period of years. So it's not cause a lot of fluctuation or cause less fluctuation in the contribution rate than might otherwise accrue. So a few years ago, we had, I believe it was about a 27% market rate return. That, otherwise could dramatically lower the rate. But what we do is we smooth the gain so as to have incorporate it more to reduce volatility in the contribution rate in any given year. The next category is the payroll base. This is what it sounds like. It's the pensionable payroll. Typically has a pretty significant impact on rates if it's greater or lower than expected, because it's the denominator over which the liability is being spread. Liability experience, this is a category that's primarily driven by salary increases relative to expectations. I have an assumptions table or slide at the back that talks about what some of the assumptions are that the actuaries use in developing their valuations. They do expect salary increases, but in the past couple of years, we've seen relatively high salary increases compared to historical norms and definitely the experience of the prior 5 years. So we're seeing a lot more of this in recent employer reports for the past year, where the liability experience is increasing because of fairly large salary increases. And as many of you may know, the pension benefit is ultimately a function of salary. It's salary times the multiplier based on the year's work. So salary is a very important input to that pension benefit calculation. Additional contribution. This is contributions in excess of the actuarially determined amount. Over the past couple of years, we've seen over $5 billion in new resources transferred by employers to PSPRS to pay down unfunded liabilities in the plan. This is where the impact is going to show up on the rate. The next one is the assumption or the method change. These are different assumption changes in how the actuaries are doing some of their work. Most importantly, for the last valuation, there was a decrease in what's called the payroll assumption from 2.5% to 2%. Moving forward, that's going to keep, at least that's going to go down another 0.5% PSPRS, as well as in Corp and the EORP plans as well over the next few years. And there's a lot of justifications and reason for that, mostly because particularly for tier 1 and tier 2 PSPRS, those are closed plans and we aren't seeing new entrants into them. So we can't expect payroll to increase as substantially as it would have in the past to help finance the cost of those benefits. But that's where you'd find the assumption or method change and its impact on the contribution rate. Actuarial audit. This was something that was done last year by the board. They commissioned an actuarial audit of our actuary we normally use to do the valuations. And what they came up with is a series of recommendations on how our current actuaries are valuing certain benefits, the timing, things like that. And so it's having an impact on the contribution rates and the funded status. This is not something you'd see every year. This is something that would occur every 3 to 5 years, however often the board decides to do an actuarial audit. And whether there's any recommendations that are actually accepted through the actuarial audit that increase costs. I mean, you could easily see it going the other way if there's other sort of recommendations that reduce the contribution rate. And the other is all other. This can be a combination of pretty much everything that's left remaining. It can include things like whether there's more disabilities that occurred than expected, some demographic data changes, but really is a combination of many different things that could have occurred. One phrase I said throughout talking about these different categories is relative to expectations, and that's a key concept to keep in the back of your head when you read these reports. All these are changes relative to what the actuaries assume the changes will be in any given year. And there's a lot of things the actuaries have to assume about the members, their salaries, how long they work, their longevity. So it's just something to keep in mind that these are all changes relative to those assumptions. Below the contribution rate, we get the funded status. The relationship is going to pretty much be inverse to the contribution rate. So something that increased the contribution rates is going to be decreasing the funded status. An exception I've called out here is the payroll assumption. It does not impact the funded status because what it impacts is how the plans fund unfunded liability, not the overall amount of unfunded liability in the plans. So just something I wanted to highlight as a part of these tables. The next section is the contribution results. So you're going to find tables for tier 1 and 2 members and tier 3 members. And this is going to show you the contribution rate, the total contribution rate for each tier member group. And then there's going to be a summary table I'll show you after these two. Just to talk about this table real quick. The normal cost, this is the amount needed next year to fund the cost of the benefits for the current employees. So in the tier 1 and tier 2 side, as you may know, the employee cost is capped per statute, and the employer bears the remainder of that. The next part of the contribution rate is going to be the amortization of the unfunded liability, which is the amount needed to fund all the liabilities accrued to date. Now, it's not literally all the liabilities, because what it is it's the portion of the liabilities that need to be funded next year. The plan spreads unfunded liabilities over an amortization schedule. Typically about 15 years. There's some nuance in that some employers elected to have longer amortization schedules for some of the legacy layers, but typically it's going to be amortized over a set number of years. So it's not literally all the liabilities that will be funded, but just that annual portion of it that gets funded as a part of the total contribution rate. You get the same part on the health side as well. Normal costs and amortization of unfunded liability. On a consolidated plan basis, there's more assets that bring down. There's more assets on the health side that bring down the cost of the health portion of the rate. You see this in a number of plans, not all the plans, but you do see this in a number of plans where the health side is relatively well funded or overfunded in certain instances. And you combine the two together, and you get the total rates, the total employer costs that's collected on payroll, which is a combination of just the pension and the health portion. And then below that, you get the alternate contribution rate, which is the same as the amortization of the unfunded liability rate. With both the employer cost and the ACR, there are instances when statute otherwise overrides the calculated rate. We see this on the corp side for corp employers. Statute has a minimum contribution rate of 6% for corp employees, and then there's a minimum alternate contribution rate as well. So there's footnotes in the reports for corp that note that for these sections. I just wanted to highlight that because I think it's one of the nuances that sometimes isn't always clear as you go through these reports. For tier 3 members, it's the same table, just calculated differently for tier 3 members. The normal cost is split 50-50 for tier 3 members. That's what statute requires. Health is the same thing. And then I'm just pointing out that there's if the plan has a legacy cost for unfunded liabilities, it would appear here. And this is the rate for the amortization of unfunded liabilities, which is going to be the same as the one in the tier 1 and tier 2 table. This is the table I mentioned that I think is a better summation of the contribution rates. This is from a specific individual employer valuation from the Department of Public Safety. It's not from the consolidated valuation because the consolidated valuation doesn't have this table. But I think this is, if you were to go and wanted to just get a summary of all the different rates by tier, and then if you have the added nuance of not being covered by Social Security as an employer for those specific employees, this is the table where you would go to find all these components put together. And it's really this total rate at the bottom that's going to be the total contribution rate for each employer. Excuse me, one moment, I'll take a sip of water. So I find this table to be really helpful when just getting a quick glance of the contribution rates by tier. Liability support. So this is another section that I think is just important to call out. This is just the liability support section for tiers 1 and 2, which is, as you probably know, the legacy program now with the closed membership pool. There's two different parts I want to highlight about this. The first is the actuarial present value of benefits. So PVB is something that PSPRS has been including in its reports for about 5 years now. You don't always see it everywhere, and I'd say different actuarial valuations or different plans. But what it is a measurement of all the liabilities accrued to date, so your actuarial accrued liability, plus the normal cost or the amount or of the benefits that need to be financed in the next year, plus the expected liabilities in the future. So PVB is really a comprehensive metric that's looking at, okay, what do the actuaries think what the cost of the total benefits are going to be, going all the way out to the last member gets paid. It is, of course, will change in any given year. There's a lot of assumptions that feed into this this calculation, but it's a very it's the measurement that tries to capture that that concept. The next one, which you may all be much more familiar with, is the actuarial accrued liability, and that's the liabilities accrued as the evaluation date. So everything earned up to that date by members and the value associated with that up to that date. Actuarial value of assets, that's the amount of assets counted into the plan up to that valuation date. And then the unfunded actuarial accrued liability, that's just the AAL minus the AVA, which is the number that I think many people are more familiar with. That's certainly what gets reported on more, gets talked about more. But there's other measurements out there. So we have these two measures of funding, and I talked about the PVB and the AAL. And what's the difference? AAL is everything accrued to date, right? So to make any progress on the PVB and what needs to be financed in the future, we got to take care of what's already been earned to date. So you got, if you're in a plan where you're below 100% of the actuarially accrued liability, the PVB is going to be less meaningful, just because to get to the point of the PVB mattering, you got to be able to finance and pay for all the liabilities accrued to date. But as a number of plans have gone that direction, the PVB becomes a new measurement to manage to and look to as a guidepost to make sure we're on the right path to funding, the benefits that have been accrued by the PSPRS or Corp or EORP members. Asset support. So this is another section that's interesting, and I just want to call out a few things about it. So it's going to have the plan investment income. It's not necessarily going to be specific to employers, but it's something to look at and say, well, how much did the PSPRS plan make in money last year in terms of investments in dollars? That's where you're going to find the amount that goes into it, and it's going to have the actual investment income, what was expected, and then the amount that's over or under that. I talked about the smoothing before. If there's a gain or a loss, it gets smoothed over a series of years to reduce volatility in the contribution rates. How this literally looks is this: you see this $71 million figure, it gets smoothed over a 7-year period, and it goes here, it gets some 71.4 million. So you can see it being applied over a series of years as part of the actuarial gain or loss. And that's true of both the gains and the losses. And then you can see the amortization schedule for future years and see what might be coming down the road. This section down here is probably more important just on an individual employer basis. This is where you're going to find the employer actuarial value of assets and market value of assets in any given year in their report. And you can use that to kind of figure out a proportionate share of the amortization schedule to see, okay, what do if you take say the AVA of assets for your employer, you divide it by the total AVA of 14.6 billion there, you can then apply that percentage to the amortization schedule and sort of get a sense of what is going to be coming down the road in terms of the amortization schedule of the assets. Member statistics. This is a section that I think is really important that doesn't always get looked at. It can inform directional movements and liabilities. It won't necessarily tell you, specifically why a certain category of liability is increasing or not, but it's going to be helpful in informing the picture. One of the first areas I'll call out is just composition of employees. We're tiers 1 and 2 are closed, so we're seeing a growing number of people in the tier 3 program. just something to be mindful of. Average salary, this is where you're going to see those greater than expected salary increases reflected. So, when we've been seeing, when Clark and I have been seeing a liability experience increase in the contribution rate, usually one of the first places we go is to the back here to look at the average annual salary and say, okay, what happened there with the average annual salary? And as I said, we've been seeing a lot of examples so far this spring with the recent reports of salary increases in the 10, 15, 20% increase from the prior year. And that's, going to be pushing up the cost of that projected benefit in the future greater than what was expected. And again, I'll show you that assumption table in the next slide on what the actuaries assume. But other categories in here that can, impact liabilities, disability retirees. Are there more disability retirees than anticipated? Drop retirees, are members going into drop sooner than anticipated? Actuaries are assuming things about how long someone's going to work. If they go into drop before they would otherwise would be expected to retire, then that's going to have a cost increase just because we're not financing the benefit for a long time period with that member. So it's just something to be mindful of that this member statistics section can really inform what's going on the actuarial side. Assumptions and methods. Always like reading the footnotes of papers, just like that. Understanding the assumptions and methods is extremely important. Assumptions inform the projections of liabilities and assets. One of the more high profile ones is the interest rate. So it's assumed rate of return over time, the discount rate. It's all the same thing for our purposes. But it's the rate at which we assume assets to accrue. It's the rate at which we discount the future cost of benefits. If it's lowered, it would increase the present value of liabilities, all else being equal. There's often a fairly, I'd say, prominent debate out in the media or amongst different folks out there, special economists, finance professionals. Is 7.2% or even 7% too high for an interest rate in a plan? Well, this comes from our most recent annual comprehensive financial report. The 3, 5, and 10-year returns continue to be greater than 7.1% and near the actuarial assumed rate of return. So, while we might in theory debate whether it's too high of a rate, there's a proven track record of meeting around the actuarial assumed rate of return. That said, there are discussions on the board currently and have been for a while about whether we should harmonize those two rates so that they're the same, whether the 7.2 should go to 7, whether they should both go to 7.1, or even go less than 7. So that's just something that the board discusses every year when it talks about the assumptions and assumed rates of return over time. And then this table to the right over here is the salary increase assumptions. You can see that it goes by age, and then by general region, Maricopa, Pima, and other. And so when I talk about salary increases relative to the expectations, the actuaries are assuming these salary increases, but increases, can and often do happen different than the expectations. These assumptions aren't made up out of thin air. They're based on experience studies that are done every 5 years by the actuaries, where they look at their assumptions and then they say, okay, based on our assumptions, how well do we think the actual data compares to that? So I just want to highlight that point because I think it is important to note that these assumptions come from actual data points. The problem, as with any forecasting or any projections over time and estimating, is you never know what's going to come down the road, and who could predict a global pandemic and the subsequent inflation that was associated with it. So I just want to highlight that these are based on actual experience valuations every 5 years. Another and kind of the last area I want to highlight in the report is there's a table at the back called plan maturity and other risk metrics. This is just one portion of the table that looks at the funded ratio. And why I'm highlighting it is because I think it's always important to keep in mind of the changes over time in these pension plans. 1 year to 1 year change doesn't really give a lot of the bigger picture of what's going on. Like most things, looking at the longer term trend is really important. And that's true of pensions. When you're looking at the funded ratio, this 65% may go to 64% in the next year, but it's the longer term trend that we're increasing the funded ratio and making sure the money's there to pay for the future benefits. And so that's just something to keep in mind, that these pension funding these pensions is a long-term process. There may be, 3 steps forward, 1 to 2 steps backwards, but as long as we're making progress over the long term, that's what's ultimately going to matter, to make sure the money is there to pay for the benefits. I had mentioned some of the discussions about the actuarial assumptions. So I just wanted to highlight them again real quick. There's the payroll growth assumption, the assumed rate of return. Those are just continue to be things that the board wants to make sure it's getting right, so to accurately reflect, investment returns, the value of the liabilities, and to pay for unfunded liabilities in the plan. And how can we help you? If you have questions about your actuarial valuations, we can give you a more in-depth understanding of your specific valuation. For things we don't know, we get on the phone with the actuary and bring them along and have them explain what's going on. We're always open for those discussions. We can do presentations for councils or board if that would be helpful. We have a modeler developed by Foster & Foster, who's our actuary. It's an Excel file that has the projection of the total cost for each plan over the next, about 30 years or so, and how different assumptions change what that expected cost is, how additional contributions change with the funded status and the employer contribution rates would be. So we have guides in the modeler available. We can send that to you. We can walk you through what that looks like, if that would be helpful. Then we can help with managing pension liabilities with actions like additional contributions or timing of contributions, things like that. So just wanted to include this slide as something to let you know we are always here as a resource. And you can get to us one through Harold. I mean, if you email Harold or the employer board folks, they'll kick over anything to us that's in our area. But you can also reach out to us directly at our email addresses to schedule anything. And with that, that concludes my presentation for today.
Thank you, Fletcher. Appreciate that. So trying to get the right slide up. I apologize. There we go. Finally got the right one up. So next we're going to discuss enrollment and demographics, and I'll be presenting Harold Green, the Employer Relations Manager.